Hi, this is Matt McAleer, Director of Equity Strategies. March 22nd, intraday today, not at the close. We have a busy afternoon, so we wanted to get the video shot where we still had some time here. I'm with Dr. Chen, who's a portfolio manager with Cumberland Advisors, and our quantitative strategist. Interesting week this week. Good bid to the equity markets. A little softening today. We'll see where that goes. Been impressed with technology. Technology keeps that strong bid. What I really wanted to focus on today is what's happening in the interest rate markets. All markets are interconnected, interrelated. We've seen the German yields, which, as you know, we've been keeping a sharp eye on for the last really 4, 5, 6 months. Back when they were 30 basis points on the 10-year, we've seen them go negative today off of some weak European manufacturing data. Our 10 years down to 247. So these are numbers that we want to keep an eye on. They don't direct us to do anything specifically in the equity market. There's always a gray area with interest rates and their effect on the other markets, whether it's commodities or equities. You can make an argument to fit whatever your outlook is. We try to stay away from that. We like the fact that at the 246 type of 10-year yield, equity total return may be more attractive than it was 5 months ago when we were looking at a 320 yield on the 10-year. At the same time, is that signaling some weakness, economic weakness? We don't know the answer to that. If anyone does know the answer to that, and they are certain of that, hide your money. Much of our analysis and research, week to week, month to month, quarter to quarter, focuses on fundamentals and macro. But we do use quantitative inputs into our decisions. As a matter of fact, for about 3 years now, we've been running a quant trading strategy. It's a shorter term strategy where entries and exits are important. Leo is our portfolio manager on that strategy, Dr. Chen, who's been working with us for about 5 years now. So Leo, why don't you give a little idea to the viewers of what some of your quant work is showing right now.
Thank you, Matt. So I'm the portfolio manager of our quant strategy. It's a trading strategy focused on the near term. So our model has been selling into the strength with the market going up above 2,800 levels. We sold our model in February, at the end of February, at the 2811 target. That was for our October trade. And we also sold our model for the November trade yesterday at our target, 2856 on the S&P. So the market has been strong, rebounding over 21% since the December Christmas Eve 2340 low. And the market also has been strong in the near term, rebounding from the 2720 level on the S&P just 2 Fridays ago. So our quantitative model extrapolates data from fixed income, equity market all over the world. And so far, the market seems to our model to be quite complacent instead of fearful. That's why we are holding cash, selling to strength, waiting for the next weakness to enter. We have our model taking into fact, for example, from the derivative market, the volatility currently is quite low, hovering around the 13 handle. It has touched 12 handle just a few days ago, but no higher than the 15, 16 level. We also have the rates market narrowing spreads, another signal for complacency. At this moment, our model still has an upside target for our December trade of around 2870 level on the S&P, but we are holding cash for the majority of our quantitative model, waiting for the next weakness to enter.
Great. Thank you, Leo. We also use Leo's work to try to position cash in our equity models. As we see some of this complacency come into the market, we have raised cash in the U.S. strategy. We're at about 20%. International is about 15% cash, and our tactical is right in that 20% range as well. Doesn't mean we are dead negative on the markets. We look for some rotation into relative strength sectors that are just starting to move from some areas that have perhaps already made their move. The other times we'll raise cash is when we are getting defensive. Remains to be seen. Remains to be seen what these interest rates may do over the next 30, 60, 90 days. Every market is like a snowflake. They look the same from a distance, but when you get up front, they're very different. what a drop in yields and a drop in rates and zero rates in Germany mean at one cycle in the market 24, 30 months ago may not be the same thing today. So we'll continue to crunch that data, continue to adjust our macro leanings and thinkings, and try to make reasonable risk-reward decisions. Have a great weekend. We'll see you next week. Hi, Matt McAleer. Wanted to invite all of our clients and friends that may be in the greater Southwest Florida area to our Financial Literacy Day, April 11th at the University of South Florida, Sarasota, Manatee. It's a great conference where we cover equity trading ideas, allocation ideas, fixed income ideas, broad market, both domestic and international ideas, lots of Q&A with the audience. And this year our keynote speaker is Gretchen Morgensen. Everybody knows Gretchen from the Wall Street Journal. We hope that you can carve out some time, April 11th, to join us. Be a fun day.